Let's get started. So thank you guys very much for joining. My name is Mark LaMonica. I'm the product manager for Morningstar Premium and morningstar.com.au. And today we're going to talk about making better investment decisions and some of the behavioral impacts that impact investors and how you can use behavioral tools and focus on risk capacity and hopefully alleviate some of these. But before we get started, we need to go through all of our various housekeeping items. So number one, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're over in New Zealand, you can get a copy of our FAP by going to our website, morningstar.com.au. And the regulatory authorities would like you to know that if you do want personal advice, you should go visit a financial advisor. All right, and the last item, of course, is it'd be great if you ask questions because it makes it more exciting for me, and that is the whole point of this, right? Okay, let's talk a little bit about making better investment decisions. First of all, let's define the problem, which is pretty easy. So we as humans are hardwired to make poor investing decisions. And there's lots of reasons for this, and we'll go through all of those different reasons. But the important thing is what, of course, is the cost of this? And the cost is pretty significant. So the cost is, and numerous studies have done this. We have a study at Morningstar where we look at Mind the Gap. But that's the name of our study. But yes, there are numerous costs. And one of them is the fact that, and one of the, in this survey and most of the other surveys that have come out, have looked at the cost is around 1.5% a year. So 150 basis points a year in lost returns from poor investing decisions. And basically what poor investment decisions do for you, and we'll go through lots of different biases that impact investors. But yeah, really what it does for you is you are buying at the wrong time or you are selling at the wrong time. So the way a lot of these studies take place, including the one at Morningstar, is we look at the difference between the return on an investment and the return that an investor receives. So if we think about that a little bit, there is an ETF or there is a fund. You can track how that ETF or fund did over time. But then if you start looking at fund flows, so when investor money went into that ETF or fund and when it came out of that ETF or fund, you can see that there can be potentially differences in those returns. And those differences are based on poor timing around buy and sell decisions. And we hear about this all the time. It's basically at times when the market is doing very well, there's this fear of missing out. There's greed that drives investors to continually, and we see this with every single bubble that forms, continually buy at the top of the market. So if you go back and look at, almost any bubble, you see huge inflows of investor money into the market right at the top of the bubble, which of course is the wrong time to invest. And then we see the same thing happen when we see negative market returns. When the market is falling, we see people panic selling, which sort of accelerates the drops in the market that generally happen right before it turns around. So these are cases of investors doing the absolute wrong thing. We know the very simple and true adage about investing is that you want to buy low and sell high. Well, investors actually do the opposite, and that's costing a lot of returns. So that's what we're going to talk a little bit about today. Okay, let's see if I can find with all of the windows open. So the problem with using my computer for these things is I keep a lot of windows open, which is not the best thing in the world. But yeah, we normally have a special webinar computer, but we've taken it away because of COVID, so that I can spend time in the office by myself. All right. No, of course I can. Here it is. Let's get into the PowerPoint. So yeah, ask away any questions. If you do have any questions after this, you can email me. So that's my name, mark.lamonica1@morningstar.com. Same thing that's on the invite. So feel free to send anything in, and I'll hopefully get back to you in the next couple days. All right, so we're going to go through a couple biases to begin with. Then we're going to walk through some examples of ways that you can combat these. But first, let's just talk about all the different ways that investors, all the different things that impact investors. So if we go back and we look at sort of the field of economics and how this stuff was originally thought about is that all the assumptions about investors were that investors were completely rational. So that means at any point in time, an investor is going to make a decision thinking about rationally what is going to maximize the wealth that I generate off of this investment. Well, that theory didn't really work. So there's all sorts of evidence suggesting that that wasn't actually true. And a lot of that theory was tied into things like the efficient market hypothesis. Then this guy came along, Daniel Kahneman, that looked at, okay, well, we are all people. We are all driven by all sorts of things that may not necessarily, or may prevent us from making rational decisions. And that's where a lot of these biases came from, which we're going to go through, today. So let's start out, and we're going to use quotes around these. So let's start out talking about confirmation bias. So we have this quote from Warren Buffett. So you can't do anything on investing without Warren Buffett. And yeah, so basically what he's saying, a little tongue in cheek here with this quote, is that all of us basically go out and we look for information that confirms what we already think. So as he's saying here is, yeah, what are we really good at? We're going to go out there, we're going to find information, we are going to interpret it in such a way that our prior conclusion remains intact so that we think the exact same thing. And you've seen this all over the place. And we've sort of seen this also just even if we move into more of a political arena where people have decided that they're only going to consume media that already agrees with their views. So a good portion of people have done that, where you start having different newspapers. And we've always had this, but it's gotten more extreme with the internet, where people are basically just spending all their time in these echo chambers hearing the same thing, which is that they're right and the other side is wrong. But we have the same thing in investing. So that all of this data that comes out, and we're constantly bombarded by data as investors, a lot of people are just going to take this data and interpret it in a way that confirms their viewpoint. And so whether that viewpoint is taking a certain investment approach is the best way to do it, a certain asset class is a great place to invest, that people are just going to have this confirmation bias. And obviously this is very, very dangerous for us as investors. So we do not want to interpret all information in the same way. What we would like to do, obviously, I think what everyone would like to do, is take each piece of information and consider it for what it is. And if your viewpoint changes, your viewpoint should change. So, there's a couple different ways of tackling this, which we'll get into a little bit later. But a very simple thing that occurs that a lot of actually militaries started doing is that you can start challenging the assumptions that you have in there. Go out and deliberately find someone that's going to challenge those assumptions. Read things that completely disagree with what you think. So from an investing standpoint, if you're a value investor, go read why growth investors think that their approach is better. At the very least, it doesn't mean you necessarily have to change anything, but at the very least, you're getting different opinions, and that can challenge some of the assumptions that might be holding you back as an investor. All right, we'll keep going through these relatively quickly. That first one was a little longer. Overconfidence bias. So as Charlie Munger, so let's go through, Warren Buffett and friends, is pointing out here that people always have problems with assessing their own ability. We see this all the time around driving, right? Where you go out there and you see these surveys where like 75% of drivers think that they're above average. Well, of course, that's not true. Mathematically, that is not true. And actually, Kahneman, who wrote pretty famous book called Thinking Fast and Slow. He won a Nobel Prize. He says that this is the most significant of all the cognitive biases. And so, he had a pretty interesting quote. He had an interview with The Guardian, and he said that it is the bias that he would most like to eliminate if he could have a magic wand. He would most want to eliminate that. And he said it is built so deeply into the structure of the mind that you couldn't change it without changing many other things. So what do overconfident investors do? Well, number one, they will put far more money at risk on a venture or on an investment as somebody who is less confident. And we always talk about less confident investors, but also people make the same mistake being very confident. They also hang on to investments too long. So, just this idea that something will bounce back, they tend to hold it until it potentially goes to zero. So what are some of the things that Kahneman came out with that said that could help you with this? And we'll get into some more later. And some of these are easier said than done, but yeah, number one is slow down your thinking and the actions that you take based on that thinking. So you can sit back, don't act quickly, spend more time thinking about stuff, and try to deliberately sit there and say, okay, am I being overly confident with that? Next thing, pretty simple, consider the consequences of being wrong. So if you're going to put all of your money into a small speculative stock, think about what actually happens if you are wrong and that, this little mining company in WA has not found the mother lode of some mineral that's going to make everyone rich. So think about what happens if you're wrong. And the other thing is broad framing. So don't think of each problem that you're trying to face in isolation. Think about all of the different decisions that you need to make, and that this individual decision is just one within many, and just think a little wider rather than just focusing on that investment. All right, action bias is a pretty simple one. This is the whole fight or flight one, right? So that all of us feel like we need to take an action, and you actually feel better taking an action than if you didn't take an action. So where does this play out? Well, this plays out once again, both when markets are at different extremes. So if markets are falling really quickly and you sit there and you see this loss of control, you're checking your account every day, which is also a good thing not to do, but you're checking your account every day and the account balance is going down and down and down and down, and you feel like you need to do something. And what's that something that people generally do is they sell. And that makes you feel better. Maybe the reaction or maybe what you're seeing does make sense that you do something, but generally what you do is going to be the wrong thing. So obviously we know over the long term, if your account value is falling and falling and falling, the market's going down and down and down, that's actually creating better buying opportunities and higher expected long-term returns. The same thing happens, of course, on the upside. So when you hear about how much money everybody's making in the market, you feel like you have to do something. It's this fear of missing out that's driving you. So what do you generally do? Whatever made it a barbecue told you about how rich they got off of this investment or that investment, you just go out there and buy it. You want to take that action to alleviate that fear of missing out. So once again, not generally the right thing to do. One thing I try to do with this in my head is most of the time with investing isn't supposed to be that exciting. It's supposed to be pretty boring. So I always think that every time I do something, chances are it's a bad thing. So I think if you think about actions are generally bad in investing, it can hopefully give you a little bit of a speed bump and you can take a step back. Okay, recency bias. So recency bias, something that's very important to think about right now. We got this quote from Michael Lewis, Moneyball fame, things that happened in the near past you think are more likely to continue to happen or happen again in the future. And that, of course, is not necessarily true. So this happens with investing when people chase performance. So this ETF went up 100% last year. It'll definitely do that again next year. I'll just move all my money into it. And we know investors chase performance. We see that around any sort of ETF or fund returns or individual share returns. And that's one of the big drivers of these gaps between investor returns and the returns on the investment. That at the end of the day, a lot of people are just chasing returns around the market. And because of the fact that you do generally have revision to the mean in terms of managers being able to outperform, that's a very bad idea. All right, information bias. So information bias is interesting. I I want to obviously put in this Warren Buffett quote, which isn't directly related, but I think still relates a little bit, is that this is the tendency to evaluate information even when it's useless in understanding a problem or issue. And we're all faced with this, especially now that there is so much, you're getting bombarded by so much noise. There's just so much information that's being thrown at you as an investor. You feel like all of it is something that's actionable, that you have to do something in response to all of this. And I like this Warren Buffett quote because it really talks to thinking long term. And one of the pieces of information that's thrown at you the most as an investor is price, right? Price movements. So this Buffett quote is just thinking about, okay, what are you actually doing? You're buying a business. And it doesn't matter if the business is, if the stock market is closed for 10 years, if you buy the right business. And, I think housing is a tricky one. I always use housing as an example here, but it's the equivalent of you live in your house and somebody comes up and knocks on your door every 5 minutes and tells you how much they'll give you for your house. And they'll walk up to your house one day and they say they'll give you $1 million. And then they come up the next day and they'll say, they're going to give you $800,000 and you start panicking. Then it's $1.2 million the next day. Well, that's very, very difficult to deal with, but that's what we're dealing with as investors because the markets are constantly open and you're constantly getting price updates. It's just important to remember that price and value can be very different. All right, another Daniel Kahneman quote. I mean, he wrote the book on this, so he gets, he gets a couple different slides here. All right, anchoring bias. So we see this all the time. So anchoring bias is the tendency of investors to rely on one piece of information when making a decision. And most of the time, this information isn't relevant to the decision they're trying to make. And the perfect example of anchoring bias is when people fixate on price. And I've done this myself. I have lots of embarrassing examples for me, but you fixate on a certain price. And that certain price can be something that a share that you own used to be worth. So if things have fallen significantly, you can focus on, and generally it's a round number, you just focus on the fact that, okay, if this used to be worth $100, so I can't sell it till it gets back up to $100. Well, what it used to be is actually irrelevant to where it's going to be in the future. But people focus on price. You can do it on the same thing when you're trying to buy stuff. And this is when I've run into this a lot, is sort of fixating on a price that, okay, if this share drops below this amount, I am going to buy it. Well, let's say the amount's $100. If it's $100.50, does that make any sort of difference? No, of course it doesn't. Not if I'm a long-term investor. So yeah, people can anchor on certain pieces of information. Specifically in investing, it is a recent share price. So it's either regret, I wish I would have bought this share when it was that low, or it's not wanting to lock in a loss because you have fixated on a certain account value or a certain share level. All right, so we're going to talk about track success in a second, but we've got some questions, so maybe we'll look at some questions. Okay, so let's see what we've got. So Bill's saying, I've always had a problem with hard sell versus soft sell. I used to have a rule that if investment declined by 5%, I would sell. One mid-cap fund went down by 6%, so I sold, only to see it go back up as predicted. Yeah, beautiful with me being out of it. Do you have any suggestions about this dilemma? Okay, yeah, I think that, okay, and we're going to get into this in a second, Bill, so hopefully that would be, hopefully this will be helpful. But yeah, I mean, one of the issues, one of the ways that people try to solve these issues is by establishing rules. And, that naturally makes sense, right? That if you know that your emotions are going to cause you to do something you don't ultimately want, that you'll have regret about, you'll just invent all these rules. And you see people like, I see this with budgeting, and you see it certainly with like weight loss, for example, that people try to impose discipline by rules. So I do think having more structure around what you're doing is probably a good thing. I I think you can hopefully, and this is harder to do, which we'll get into in a second, put some of that structure around sort of the process you go through to make a decision rather than structure around something like that where, okay, if it falls 5%, I'm going to sell. So instead, you kind of want to think about what that thesis is and realize that price movements don't necessarily mean that your original thesis is wrong. So we'll get into some of that. And Bill says one of the things I like about an investing approach is that everything you do is wrong. Yeah, we just recorded something for another podcast today, and we were talking about this, that there are all sorts of different approaches in investing, and the point is to find one that's comfortable for you. Because if you're comfortable and you have that intellectual framework that you agree with, that makes it a right approach for you because you're less likely to do stuff like that. So yeah, it's a good point. Bill, you were winning participant of the day, 3 questions in a row. Yeah, so Bill's saying he recently invested into a fund that he was not aware of that it existed. I found that it constantly gone up very well since November 2020. Yeah, along with everything else. One day after I bought it in like July, it hits high and has been going down for the past 6 weeks. The opportunity cost of this decision has been huge. I see no way out of this dilemma except sell and suck up losses. Yeah, any comments? Yeah, I mean, it's hard to obviously know without the fund. Not that I could tell you what to do if I did know the fund, but yeah, I think it's once more, it's sort of putting structure around the investment decisions you're making. Why were you actually getting into that in the first place? So yeah, all right, we're gonna go. We'll get back to the questions. There are some other good ones, but we'll try to get through some of. Oh, that's the wrong title. Ignore that. It was a hectic morning. But these are different approaches that you can take, and we'll go through these in detail, that you can take to alleviate a lot of these behavioral biases that impact investors. So number one, and I'll show some examples for this, focus on long-term time horizons. So one of the problems that investors get, well, hey, I'll show you something. How about that? This is always exciting when I try to switch the screen. Pictures of motorcycles for some reason. Oh, that was from a team trivia. I remember what that was now. Will participated in the team trivia. The winners got a gift certificate. I think Will got everyone wrong. Or you came close, Will. Will is not good about knowing other people on the team. All right, now of course I can't find this page because, all right, hold on a second. I will find this. So yeah, I want to take a look at, oh, now I know what I did. I want to take a look at something we just released on the website as an example of how you can use some of these things. So we did just release this new page. The point is not to really talk about that, but I want to talk a little bit about market data and how you can keep a long-term perspective. So we just pushed out this new page that looks at market data and obviously trying to do something to help investors and not give them exactly probably what they all want. What we chose to do is start the page with a couple different things. Number one, that you should focus on long-term horizons. So we defaulted to a year, and the minimum we had on these indexes was a month because we wanted investors to have a little perspective. One of the problems is people are bombarded by this data. So one of the good things to do is don't check unless you can emotionally handle it. Don't check how the market does every day, particularly when there's a lot of volatility, when it's going up or down a lot, and instead focus on long-term time horizons, right? When we're going back and we're looking at a 10-year period, you can say, okay, well, look at all these different dips we had. So that's obviously the dip we had post-COVID, but at the end of the day, look, the market's trending up. And what I need to do as an investor is not panic when there are these relatively large dips, in this case in the ASX 200. So whenever you're sitting there and feeling a little bit of anxiety around the way the market's bouncing around, go back and look at longer time horizons because generally they look pretty good. And that can provide a little bit of perspective and hopefully reduce a little bit this action bias that you need to do something. The other thing, the next thing we had on that slide, if I remember the order I put them in, is I just printed out a bunch of blank pieces of paper, which is less than helpful. The next thing on that slide is we talked about valuation. So why do you want to take valuation into account when you're looking at market movements? Because typically valuation is going to move in the opposite direction of the market, and that can give you some perspective. So when the market is doing very well and you have this fear of missing out, focusing on valuation can be helpful. So what we have here is for all sorts of markets around the world. We look at the Morningstar price to fair value of the overall market. So what do we have here? We can once again go to a longer time frame to do this. And we can start looking at, okay, when are the times you actually wanted to buy? Now, this is basically moving, this chart right here is moving in the exact opposite way as the market. So what is this thing right here? That is the fall we had after COVID, part one. I don't know what part we're on anymore. Feels like the never-ending part in Sydney, but yeah, this dip right here from a valuation perspective. So anything below this line, we think the markets are undervalued. Anything above that line, we think they're overvalued. So that dip is COVID. Good opportunity to buy has kind of been played out since then. But it's also really important to look at valuation. And so what we try to frame this a little better for investors is start with these longer term perspectives, include valuation before we get into day-to-day changes in the index. So that's one approach that you can take and think about the different market data that you consume, right? A lot of people, I'll admit that I do the same thing, sort of wake up in Australia, you see what happened overnight in the US because it's probably going to have an influence on the Australian market. And that's fine as long as you realize that that is noise. Day-to-day market movements are noise and should be avoided at all costs. Okay, let's go back into the PowerPoint. We'll talk about a couple other of these. All right, the other thing that's very important is to track your success. And I know that I say this over and over and over again, but track your success in relation to goals. So really, really important. And the reason you want to do that is because once again, what that will do is it'll provide some perspective to those returns, and it will hopefully push you into making better decisions. So the simple example that, I think we've talked a lot about on the podcast, but the simple example is when you are focused on the required rate of return, so the amount of return that you need to actually achieve your goals, think about what happens. If the market goes up a lot, that required rate of return goes down. What is that telling you to do? It's telling you don't have to take as much risk. Now, I wouldn't go out there and sell everything you own, but potentially it's going to tell you that, okay, maybe I don't need to put all this new money into the market. Maybe it's not bad if I build up a cash balance because my required rate of return is going down. When the opposite happens and the markets are falling significantly and people have the tendency to panic and sell, what's that required rate of return doing? Well, it's telling you, okay, that's not what I should do. My required rate of return is going up. I need to invest more. I need to take on more risk. So it's really good to provide that context. And kind of once again, it's just easy for me to go here since I kind of decide what goes on there. We've been focused really on making sure, like obviously that goal setting feature we have, but looking at returns within that context, right? So putting portfolio goal, what's the required rate of return, and using that when we start looking at annual returns on these different portfolios and comparing them, right? Because it's going to give you that, perspective to take a step back and say, okay, what should I actually be doing to accomplish my goal here? And oftentimes it's the opposite of what everyone else is doing. So at the top of the market, after really, really strong returns, what you need to achieve your goal is not shove a bunch of money in to the market because your actual required rate of return is getting lower. All right, we're on a roll now, switching back and forth between screens. So, good accomplishment. Okay, the last two steps, and this gets into Bill's question before, around trying to create a little bit of structure, trying to create almost a speed bump. Remember we were talking about before about slowing down that decision-making process, trying to create a little bit of a speed bump to to making decisions. And two things you can do to do that is just write stuff down. So create an investment policy statement. We'll get into what that is in a second, and document the rationale behind your decisions. And so in that example that you were using, Bill, is if you wrote down before you invested in that fund, I believe it was a fund, before you invested in that, why? What was your thesis? Why were you investing in that? Then you can sort of see, okay, well, if it's fallen 6%, is that thesis still intact? And maybe it's not, and maybe it is time to sell, but just that structure, and just by writing down and sort of justifying, you're almost going to challenge your own conclusions by writing something down, that can create a little bit of a speed bump. So let's look at an example. So I put an example, a personal example on here, in the spirit of transparency. And one of my goals, so you can have multiple goals. So I've got a retirement goal, but I've also got a goal to generate income from part of my portfolio to pay for my life now, since I'm spending so much money in lockdown. But the idea behind this is to generate some cash flow through dividends that I'll just spend right now. All right. So what is the goal? And I didn't put all the details. I wasn't that transparent around how much and things like that. But basically, what the calculation is on here is that I'm 42, in case anyone's interested, that by 50, what I would like is I'd like to hit a certain level of passive income from a certain account that I have. And in order to get there, when I calculated the quote unquote required rate of return, in this case, based on income, not on account value, it was 8% a year. So what do I want to do? I want to grow my passive income 8% a year. So I've defined my goal. Then what that flows into is this investment policy statement. And the reason it's good to write things down is because then you can, number one, define the types of investments that work for you to accomplish your goal. And there's nothing good or bad about Bitcoin, for example. Will's a big fan of Bitcoin. There's nothing good or bad about it, but Bitcoin doesn't generate income. All right, so Bitcoin does not work for this portfolio. That doesn't mean it doesn't work for Will or for anyone else who wants to invest in it. What it means is it doesn't work for me. It's not going to help me accomplish my goal. Investing in a speculative stock that doesn't pay a dividend doesn't help me accomplish my goal. And so hopefully what that does is, by aligning investments to your goals, it prevents you, number one, from this sort of fear of missing out, where everyone starts throwing money into speculative investments at the top of the market. And then also allows me, if the market is falling, it allows me to go in there and evaluate investments based on my criteria. So let's go through this, and I'll sort of explain what's on here. And then we've got an example of something I actually bought last year. And I put in a very good example that has done well. But yeah, every once in a while, I guess I can put in an example of something that does well. Okay, so what am I trying to do? If I want to grow my passive income by 8%, I'm looking at individual shares that have sustainable dividends that I believe can grow faster than the rate of inflation over the long term. So that's sort of my criteria of what I'm looking for. Why am I looking for individual shares? Well, income can be very lumpy from some collectively managed investment vehicles like ETFs and funds. Now, it doesn't mean I don't use them. I just generally use them more in my retirement accounts because I have a different goal there. So what do I want? I want to purchase companies that have a dividend rate that's higher than the market, so higher than average, which still have growth potential. And this growth potential thing is important, especially around sustainability, because you're making trade-offs. And we'll talk about this on Thursday when we talk about income investing. You're making trade-offs between, many times, dividend growth and how high the dividend is. So people that chase yields, they're like, oh, this thing's yielding 10%. Well, remember, dividend isn't guaranteed. Reasons yielding 10% is probably because the market thinks it's going to go down. But there are trade-offs between growth that you can compound, especially with a dividend reinvestment plan, and just a higher regular yield. All right, so I want growth potential. I want it to be sustainable. So what does this lead itself to? It's buying securities that are temporarily mispriced. So what I'm looking for is something where, if there's a giant market drop, or if there's a very company-specific issue that I can look at and think potentially isn't long-term, that's a good opportunity to buy something, because of course dividend yields go up when the market goes down. So as long as that dividend is sustainable, this is a good opportunity. Now, this also says that I generally would invest in non-cyclical industries. So if I want a steady dividend that's growing, to invest in a very cyclical industry, which is going to do really well at certain points of the economic cycle and really poorly at other points, is probably going to make that dividend less sustainable. Now, it doesn't mean you couldn't invest in this, but generally, I would look at non-cyclical businesses. We want a strong balance sheet, right? So we want them to be in good financial strength. And we want a reasonable cash flow payout rate. So basically, of the cash they generate, we don't want them paying out 100% in dividends, because that's a lot harder to be sustainable. So this is kind of the notion of, okay, and this doesn't mean that this is the right way to invest. It doesn't mean that this is a successful way to invest. This doesn't mean this is right for anybody. But what it's trying to do is write out something that's right for me in terms of that goal that I'm trying to accomplish. So it gives me this kind of rationale when I'm going out there and evaluating individual investment opportunities. It's just because some mate at a barbecue says that I should put all my money into Zip, I can come back and say, okay, well, that doesn't fit my framework. That doesn't make Zip a bad investment. What it does do is it says it makes it a bad investment for me. So that's an example. So the last thing was document your rationale. And this is where, I'm going to talk about something I actually did right for a change, is back in this sort of COVID-related market fall. I bought this company called Constellation Brand. So basically, it's mostly a beer company. So they do have some wine and some spirits, and actually a little bit in a Canadian marijuana company, or cannabis, or whatever I'm supposed to call it, not weed. So Constellation Brands, I went back and I bought that during that COVID fall. And so by defining sort of what I was looking for, that did allow me to sort of overcome the, panic that was out there from both what was happening in the market and the unknowns around COVID, which seems to have turned out a lot worse than everyone thought. But that allowed me to try to find something that met that criteria. Now, what I did is I just jotted down some reasons why I actually invested in this. And yeah, you should probably do more. You should probably do research, right? I did do research on this. But I jotted down some reasons why I bought it. So it's a high quality stock, right? It's got a wide moat rating from Morningstar. So that means it has sustainable competitive advantage. We have a capital allocation rating. So how does management allocate capital? And that came back as exemplary, which is our highest rating. So management's doing a good job sort of managing the capital they have. They've reduced leverage on the balance sheet. So they paid off debt, which is good things. And it's a lot healthier than it had been. So I got that from looking at financial statements and then, of course, reading Morningstar research. We have an uncertainty rating. That is how uncertain those future cash flows are. So the more uncertain they are, the more variability there could be. So because this is sort of a beer company that is certainly, non-cyclical, people buy beer when things are going well, things are going poorly. I thought, okay, this is potentially an opportunity, right? It operates in the consumer defensive sector. Looked at the dividend payout rate, so it's about 45%, so not too high. So that's the amount of earnings, and there's a caveat here, it's the amount of earnings that are paid out in dividends. So if you pay out all your earnings in dividends, then the problem is that if your earnings fall at all, you're probably going to have to cut your dividend. Now, the caveat is this is only for certain types of companies. There are companies that, like utility companies, infrastructure companies, real estate companies, where you'll see higher payout rates. That's when you want to look at cash flow, which I said before, cash flow and not payout. We'll talk about all of that on Thursday. And then the other thing is, stock was yielding. It's not good for Australia since there are higher dividend yields, but 2.57% at purchase. So not a huge dividend, but I thought there was growth potential. It was higher than the market. And the stock had fallen. Everything was falling. But it actually fell larger than, it fell more than the market. Now, one of the reasons behind this, and this is sort of the idea behind this temporary, temporary drop, is I think the reason is people are idiots. So Constellation owns and sells Corona in the US. And I think this was overblown by the media, but there was all this talk that dumb Americans, and I'm a dumb American, so I can say that, the dumb Americans were going out there and not buying Corona beer because they thought it had something to do with coronavirus. So, obviously, if we had if I had $1 for every misinformed American there was around coronavirus, then I wouldn't need to invest or work. But I think that was overblown by the media. I think they interviewed a couple of idiots outside of a beer store and decided everyone was doing this, but the stock got hammered. And you wouldn't expect something like this, a sort of consumer defensive stock, to fall more than the market during volatility. So anyway, the point is, writing all of this down gave me rationale for why I purchased this, which means that if the price starts moving around, now the price has gone up significantly since then because everything's gone up. But if the price continued to fall, I could go back there and revisit this rationale and say, does this still make sense? And that can provide a little bit of structure. I'll be back on Thursday. We'll talk about income investing. So spend a little more time looking at income investing. So hopefully that's a little more relevant, Phil, to you and your time horizon. But anyway, thank you guys for joining. I appreciate it. And sorry for going over.
Any advice in this video is general advice or regulated financial advice under New Zealand law, prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited, without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.